Passive Pockets is presented by Equity Trust.
Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. My name is Chris Lopez, and I'm joined by my co-host, Paul Shannon, today. And this is our first episode in a little mini-series we have where we bring in some really smart people, come talk about what happened in 2025, and then some predictions in the future.
And today we've got Brian Burke on the show. I'm excited to pick his brain. He's always so insightful. We're going to look back at what he called correctly in 2025, what surprised him, and the most recent investments he's made at his sponsor and personally. That's the rear view, but then we're going to jump and grab the crystal ball and we'll look to 2026, the trends he's watching, where he sees opportunity, where he's putting his own money, and what he's avoiding.
Brian, glad to have you back on the show. How you doing?
I'm doing great, Chris. It's great to be back. Thanks for having me.
Paul and I are excited to kind of jump in with what we call like the rear view, right? Let's look at 2025. What did you call correctly? Like, what did you expect? And what actually happened and went the way you thought it would?
I can think of two things, actually. One is I came up with a bunch of sayings. And I think I put them on this podcast maybe earlier this year about what was happening in multifamily real estate primarily, to counteract the survive till 25 crowd. And I had changed that all up to say that 25 was really end the dive in 25, because before multifamily prices would go up, they first had to stop coming down. So did I call that correctly in 2025? Did prices stop coming down in 2025? I don't know. I think so, or at least the acceleration has been greatly reduced, or the deceleration, I guess you would say. So maybe I called that, or maybe I was a little bit optimistic. The other thing I called correctly was senior housing. We made a pivot into assisted living, skilled nursing, and memory care, various senior housing asset types early this year. I think we called that correctly. I got a little bit of validation to that opinion in a couple of ways recently. Just last week, the National Council of Real Estate Investment Fiduciaries came out with their rankings of commercial real estate and ranked senior housing as the top performing asset class across all commercial real estate asset classes in Q3. So I think I called that correctly. PwC and ULI put out their emerging trends in real estate report. That recently came out. You can download that online for free. And they called out senior housing as a top commercial real estate asset class. And that one, I really put my money where my mouth is. We invested heavily in that asset class this year, and I think we called that correctly. So maybe I got those two right.
Okay, that's a pretty good clip there. Good batting average. I'm going to take the opposite take, Brian, and ask you what surprised you the most in 2025. We all don't have a crystal ball, right? But we certainly like to pretend we do sometimes, and we're not always right. So what were some of the things that caught you off guard maybe a little bit or surprised you in 25?
I think the biggest one that I can think of is in multifamily, there was a lot of belief, and myself included, that in the second half of 2025, we were going to see a dramatic fall off in new construction deliveries. And I don't think we've seen that to the extent that I expected, and perhaps maybe that most people expected. New construction deliveries have remained elevated throughout 2025. I think maybe in part due to construction delays, just keeping projects going longer than they had planned, but also in part because I think that some people thought the same thing, like, construction's going to taper off. So if I build now, I'm going to be good because I'm going to be the only one building. But if everybody thinks that, then everybody's still building. So I think there's more new construction deliveries in multi than I would have expected to find.
Is there data that you've seen that supports that? And is there an eventual decline where you see demand and supply kind of leveling off at some point?
I'd love to point to a specific source and say, yes, this is the numbers that I have, but I don't. Just reading, anecdotally, I read a lot of news. I mean, most of the time, people think that investing in real estate is glamorous and you're out, kicking tires at properties and stuff like that. But really what you do is you sit behind a computer and read news all day. And, just reading various takes and articles about new construction deliveries and the pace of construction, everything I'm reading is pointing to the fact that they remain elevated. But I couldn't quote you a specific statistic. I'm sure those statistics are out there. I should probably look it up, especially before I talk about it on podcasts. But nevertheless, for just the anecdotal that I'm seeing out there, is the deliveries remain more elevated than I would have thought.
I got a question I've been down to ask you, Brian. I know, you as a company, you guys pivoted to assisted living and you've done done some deals this year. I'm curious, like, what was the last investment deal you invested in personally? Real estate or non-real estate, kind of like in your global investment portfolio.
Well, a few things. Obviously, I've made some personal investments into our senior housing fund, as a co-investment. But I've also, outside of that, for the last few years, I've been investing in individual stocks. I've been expanding some positions. Every time the market goes down, to me, it's like, you go to the store and there's like a sale rack. So I think, the stock market is probably the only market in the world where people fear a sale. And I love a sale. When prices go down, it's a good time to go in and buy shares of companies I want to own at better prices. So I've been doing a lot of that. That's probably been my biggest personal investment. I've also been doing some investment in private offerings related to biotech, some new drug startups, biotech startups, and that sort of thing. So a little bit more kind of risk on than the risk off stuff, because I think my real estate investments, my debt fund investments really give me a lot of stability, predictability, and kind of the things that we all look for in passive investing. And I want to have some risk on exposure to some of those things that are maybe a little bit less certain.
In regards to buying things at discounts and being a bit more risk on, it looks like Bitcoin is a bit discounted right now. Are you buying into the crypto phase?
It's funny you say that, because I'm actually looking at perhaps putting in a trade today, because, pricing has come down quite a bit. I mean, I bought a little tiny bit of Bitcoin when it was at like 95,000 before it went up, and now it's back down. And I'd love to see it get to like 50 or 60 grand. I'm probably going to get death threats for even suggesting that, but I would kind of really like to see it get that low, because then that might be a time where I might jump in a little bit more heavily. But to answer your question, Paul, yeah, I'm thinking about maybe that as a little bit of a possibility.
Let's shift the topic, Brian, to, we talked a little bit about the rear view and what happened in 2025. We're just about a month away from 2026 at the time of this recording. So this is the fun part where we get to bring out the crystal ball, so to speak, and see what's on the agenda for next year. What's kind of interesting to you? Where do you see the market trending? So let's talk about maybe 2 to 3 trends that you see that you're watching closely in 2026.
I'm obviously, like everyone else in commercial real estate, watching interest rates very closely. I think for no real reason. I don't think anything exciting is going to happen. I just think that I'm watching it because I need to watch it. I'm watching investor sentiment closely, because I'm still hearing a lot of positivity in some commercial real estate sectors, like especially multifamily. Multifamily has been a core competency of mine. I've been in that business for decades. And, I sold most of my multifamily right before the market collapsed in 2022, and kind of feel like I called that pretty well, but I'd still like to get back in when the timing is right. I'm watching sentiment closely in multifamily. I'm waiting for more people to say that they dislike it. And I haven't heard it yet. Everybody still finds reason to like it. I want to find more people saying that they dislike it. So I'm watching that. And I'm watching new construction delivery, information, what's going on with new supply, because I think that's one of the biggest headwinds. I think the biggest headwinds in multifamily that I see is new supply and interest rates. I think maybe a distant third is expenses, because I think those are kind of starting to take care of themselves, and we're not seeing the expense growth that we were seeing a couple of years ago. So I think I've seen what I need to see there, but I'd like to see a little bit more clarity and maybe directionality on interest rates, and a little bit more negative sentiment on the investment itself, so that then I could kind of jump back in.
What circles are you in where people aren't native on multifamily? You need to come to one of these complaint fests I have once in a while, Brian.
Yeah, maybe that's right. I need to hang out with you guys then. That makes a lot of sense. But I don't know. There's just still too many people saying this is the time to buy. And I might give that advice in small multifamily. I think small multifamily is a real opportunity right now. If you're buying duplexes, fourplexes, 10 units, 20 units, maybe even 50 unit properties, there's some real opportunity out there. One thing people don't talk often enough about, I think, is perfect versus imperfect markets. It's kind of a topic we could probably have a whole show on, but something that people don't really touch on too much. And the small multifamily is a little bit more of an imperfect market. And imperfect markets are ones where you don't have, buyers and sellers on the same page And you can find really good deals, those needles in haystack kind of deals, like, the one Paul is working on. There's stuff like that you can find out there if you really want to turn over a lot of rocks. Large multifamily is a little bit more difficult because the buyer pool is made up of professionals that are studying this day in and day out. It's a much more perfect market. Even when you had a bid-ask spread, it's still a bit more of a perfect market. You don't hear of anybody say that they bought a large multifamily complex for 50% of what it's truly worth. They might say they bought it for 50% of the asking price or 50% of what it sold for 5 years ago or, whatever. But 50% of what it's truly worth, no. But small multifamily, you can do that. So, I think that's conflicting market, right? Where there's opportunities in certain pockets if you know where to look.
I think that nuanced take is spot on. And it's a lot like the mom and pop landlords I've seen where they are just tired or they're distressed or they're ready, right? They're ready to go fully retire. I think some good opportunities in that small multifamily. All right. So I'm curious as to if you see any other opportunities in asset classes. Obviously, you're very bullish on assisted living, cautious on multifamily right now. Any other real estate investment opportunities or asset classes that are on your radar?
Not really, but mostly because they're outside of my core competency. I think that there could be an opportunity in office if you really know what you're doing and you know what you're looking for and you're in the right market, because prices have come down so dramatically that there might be a real sale there. But it's not something I'm closely watching because, I just am not that close to that market. And I learned a long time ago, I've been doing this for 36 years. And when I was young, I was wild. And it was like, I got to try everything. I'm going to do hotels. I'm going to do self-storage. I'm going to do mobile homes. I'm going to do all these different things. And you do all these different things and you realize okay, this is the narrow lane that I found that I'm really good at. And every time I stray out of that and try something completely different, I get my hand slapped. And so when we went into assisted living, I've learned my lessons from years past. So it's okay, this is outside of my lane. I need to bring someone on that's an absolute expert in this space if I'm going to try this out. And that's how I was able to do it. And so if I were to go and do say office, for example, or, some other asset class that I think that there's an opportunity in, I'd have to bring someone in that was a true expert. And that isn't me. So it's hard for me to say that I have my eyes on it. Okay, next year you're going to see me launching a fund to go buy office. You're probably not going to see that.
I think what you say transfers so well to the passive investing community. It's kind of like you want to have enough diversification where you're not pigeonholed into one asset class, where in multifamily in 22, 23, we saw this big downswing. You want to have a broader asset allocation and portfolio construction. But at the same time, you don't want to be on the opposite end of the pendulum and have kind of the tendency to chase the shiny objects, so to speak, and just get into all these deals because they look good on paper, the OM looks attractive, the pitch deck, et cetera. So from a passive investor standpoint, you really want to, you find the right person to partner with and bring them in internally who's an expert in that space. As a passive investor, you want to find the right sponsor who's in that asset class, who has a track record of excellence, who has a team built around them, who knows their market really specifically. And then you trust them to find the right deals, right? You may have some analytics, you may have some market knowledge and some questions you ask the sponsor, but you're really leaning on their expertise. And I love that take from your perspective as far as how you run your business and find the right people to work with.
I think you've just summarized the whole concept of passive investing in what you just said, Paul, because the reason that you passively invest, there's really only two reasons I can think of. One is because you don't want to do all of the work, right? And the other is because you may not know how to do all of the work. And so that's the reason why you passively invest. And you want to find the right sponsors that have, exactly as you said, the track record and experience. And that's why you're investing with them passively. Otherwise, you could just go out and do it yourself.
So you talked a little bit about what you're avoiding. Multifamily was one of those asset classes. I kind of take the opposite. I feel like we've already hit the trough and now's a great time to invest if you're willing to kind of blow through the caution flag, so to speak. But we can save that conversation and debate for another day. What are some other things that you're saying no to or that you feel are a little too risk on right now for your appetite?
In real estate, not much of anything, because I've only decided to say yes to the things that are within our traffic lane, right? So we're doing, multifamily and senior housing are the things that I think probably the only things you'll see us really tackling. I think that there's, self-storage has been a little bit overbought. I look at this mostly from the lens of a passive investor. And, Us as an investment sponsor, I have two jobs, basically. One job is to find the right place to allocate capital, right? So that's choosing asset classes and that sort of thing. But the other is to try to find a lane where I'm providing something that the passive investor needs. And, that's really the core of any business, is provide a product that's in demand. From a passive investing lens, a lot of passive investors are probably over allocated to the multifamily space because that's really the only thing people were investing in for probably 5 or 6 years. Most of the sponsors were in the multifamily space. And so investors put a lot of capital into that. And so now for me as a syndication sponsor, how do I stand out from all the other multifamily out there? Well, of course, we have the advantages of being in the business for decades and we have a great track record and all those things. But really, when you bake it down to the actual investment itself, how does the investment itself stand out? And it's difficult to do that when you have investors who may be over allocated into multifamily and they need to find other things. So I don't think I'm really looking to expand multifamily right now. I think, when I find better conditions for a syndicate sponsor to be in multifamily and large multifamily, and I think investors have more of an appetite for that, then I'll shift more back to that strategy. So I think to me, it's looking for where there's a weakness in where investors need to fill a hole, and that's why senior housing is unique. Not many sponsors are doing it. Not many investors have an allocation to it, and it's the right asset class for today. So that allows me to stand out. Whereas if I just go back and buy another apartment complex, what have I really done?
I want to shift to just a longer term view, a little bit more crystal ball here for you, Brian. So, you read news all day, just kind of like medium to long term. So next few years of where you think interest rates will be. And specifically, hey, we got what the Fed can cut rates, but also we have what the bond market does with the 5 and 10 year. And I'm kind of curious your thoughts where you see both of those and if there might be some type of divergent, because obviously that might have a big impact in all these commercial investments.
Anybody that's predicting where interest rates are going has one thing in common with each other, and that is that they're all going to be wrong because nobody really knows where interest rates are going. I look at the forward curves that are put out by interest rate experts, and forward curves are showing a reduction in interest rates over the short term, call it the next 1 to 3 years, and then a gradual increase in interest rates where 10 years from now, we end up right about where we are right now. So that kind of tells you, I think interest rates are going to be pretty level. I don't see a catalyst for a massive interest rate reduction, especially at the long end of the curve. We might see some moderate, slow decline in the 10-year. I think I would like to see the 10-year get below 4%. But what I would like and what's actually going to happen just seem to be completely disconnected. I think on the short end, I'm fairly confident we're going to see a reduction in the SOFR index. SOFR is the secured overnight financing rate. It's what most floating rate commercial real estate debt is tied to. That index is influenced heavily by Fed decisions and, short-term bond action. Those are pointing towards easing of those interest rates, which is going to help some floating rate debt. And, not just bridge debt, but also floating rate agency will get some benefit from that, at least for a while until it starts going back up again. But really, a lot of the influence over long-term real estate is the 10-year bond. And the 10-year bond just seems to be very resilient. It's not, the rates aren't coming down much. Even though, we see lots of reasons for pressure to bring them down, it's not happening. And I don't really know that it will. I think we have to get used to this being, the new normal. And the new normal ain't so bad. When I bought my first house, my mortgage interest rate was 8.5%, and things were fine. So I think we're still in a decent spot. It's just we got addicted to artificially low rates for a while, and people think that was what was normal, and it's not normal.
We had a little talk on a segment of our show last week about interest rates and how interesting it is to see the drop in the federal funds rate and how it corresponds with the longer end of the curve and where multifamily transactions are happening today and the financing that's getting used on those transactions, and it's really not impacting 5, 7, 10-year debt whatsoever at this point. So there's a lot of factors at play when it comes to interest rates beyond just the Federal Reserve and their decisions. But with that, what I'm hearing is that you think that there'll be sort of a higher for longer rate environment. How do you think that impacts, let's say, next year into 2030? I can't believe 2030 is right around the corner here, but How do you think that will define the next 5 years for real estate investors?
As you alluded to, even when they've been lowering rates, sometimes that causes the long end to go up, right? Because then you think, oh, well, that's going to stoke inflation, and therefore inflation is going to mean that I need to get a higher long bond rate in order to justify the risk. So I think there's been a lot of hope for lower interest rates to create profits in income real estate, because there's an old saying that the money that you make is contained within the difference between the cap rate and your borrowing rate. So therefore, if you buy something at a 5 cap and you borrow at 4%, there's a 1% difference. But right now, what you're seeing is you're buying at a 5 cap and you're borrowing at 6%. So it's a negative 1%. So by that definition, you're losing money in commercial real estate, if that's your definition. Now, in the real world, it doesn't always exactly work out that way, but still, you got to think about the relationship between cap rates and interest rates. And ideally, you want to see a positive delta between cap rates and interest rates. And with cap rates in the 5s and interest rates in the 5s or 6s, if the interest rates don't come down, what does that tell you? The cap rate could have to come up. And while that may seem like complete blasphemy, I remember when, multifamily cap rates were 7 and 8% all day long. There was a time when that was normal. 4% cap rates and 3.5% cap rates that we saw in like 2020 were not normal. I think that it's going to create a headwind to cap rate compression, but that doesn't mean that there can't be price appreciation, because price appreciation comes from two things. It comes from income growth and cap rate compression. So if the cap rates don't compress, where do you find appreciation? You find it in income growth. Income growth primarily comes from rent growth. And right now we've had very little to none of that. In fact, rent growth has been negative over the last year in a lot of markets. So that's been a real headwind to pricing and why multifamily pricing has come down. So what do I see going into 2030? I think once new construction deliveries really do slow down in a meaningful way, we'll start to see rent growth come back once the supply and demand picture equalizes. And when that happens, we'll see rent growth again. Rent growth will lead to income growth, and income growth will lead to price appreciation, even without cap rate compression, or even with cap rate decompression, if that were to occur. And we'll end up eventually getting to an equilibrium where pricing at today's interest rates makes investment sense. Even if I can't make sense of it today, those conditions will return.
All right, Brian, I want you to put your LP hat on for my last question here, since we're looking at the 5 years, right? And the question is, how should LPs be positioning themselves, say, for the next 5 years? And you accurately described a lot of people, myself included, are heavily weighted to multifamily, direct ownership, syndications, all that. Like, with that, investor in mind, next 5 years, like, what guidance or ideas do you have for how to position?
Well, it'd be self-serving for me to say that they should invest in senior housing. That's where I'm putting my money, because I think it's going to be a solid investment asset class over the next few years. But I think there's other asset classes that you could look into as well. There's data centers is the other kind of like number one real estate asset class. One thing that was really prominent in the PwC and ULI report was how real estate that has a component of necessity is really, it used to be considered like niche asset classes, but now is really a mainstream asset class. So anything that is real estate by necessity. So senior housing, medical office, anything where you have to have that real estate use, hospitals, those kinds of things where it's a needs-based real estate. If you can find needs-based real estate, I think you've got a winner. And I think that's why data centers have done so well. Data centers would have been considered a niche real estate asset class, but now it's becoming somewhat more mainstream because the processing of all the data with AI and everything is becoming so important that I think that's one of those reasons. So I would think look at real estate that has a must-have component and be careful about real estate that has an optionality component. And a lot of people would say, well, housing is a must-have component. And while that may be true that everyone needs a place to live, that place doesn't necessarily need to be your apartment. They can double up and live with friends. They can move back in with their parents, roommates, all those kinds of things. So there is a little bit of a optionality in some housing types that you have to be careful about. But any real estate where there's a needs base, I think that's the place I'd be looking at over the next 5 years.
It's pretty easy to debunk the everyone needs a place to live, quote unquote, thesis, right? It's not really true when it comes to multifamily. I really buy into your thesis on assisted living. The more I read about it, the more I'm seeing clearly that there is a clear supply issue here. There's a lot of demand. The baby boomer generation is aging. There's going to be more and more demand, and there just isn't enough assisted living facilities currently today. So usually a favorable supply and demand situation from an investment standpoint works out in favor of the investors. So that's, I wouldn't say a contrarian play. It was very data driven, but do you have any, let's say, contrarian beliefs about real estate right now that maybe the majority of folks wouldn't agree with?
Well, oddly enough, Paul, this was a very contrarian position when we started a year ago. When we started writing offers on assisted living facilities in November of 2024, it was very contrarian because people were like, oh my God, COVID has destroyed the business and, it's in a downslide. No, it's like, no, it's bottoming right now, and so it was contrarian, but now all of a sudden everybody's catching on. And the best way to get into real estate is to get in right before everybody else knows something to be true. You take the other side of that trade. And then when everybody else figures it out, you get to ride the benefit. So what's contrarian today? I mentioned it earlier in this show. I think there could be some opportunities in office investing. And that I think would be very contrarian, but I think you have to have an iron stomach because it's not going to be an easy and smooth road to get to profitability. And I think you have to have an operator that really knows the space and is investing in a geographically very smartly. So I think that could be a contrarian opinion. And if I was to invest in something as an LP, as a passive investor right now, aside from what we're doing in senior housing, I would probably be looking at opportunistic plays, either in office or maybe something like what you're doing, Paul, with, smaller multifamily where you're finding needles in haystacks, which really to me is more of an arbitrage play than a momentum play where you're like, hey, I'm going to find a needle haystack. I'm going to make improvements and these kinds of things. If you can find those kinds of really unique dislocations, you can make good money even today. And I think that in itself is a little bit of a contrarian play.
Well, you don't have to twist my arm on that one. I think you referred to it as an imperfect market or a inefficient market, and there's certainly ways to exploit opportunities there. And the more efficient a market, like public markets, for example, blue chip stocks, they trade within instances. The bid and the ask are very close together. There's lots of buyers, lots of sellers. The opposite of that is there's not as many buyers and sellers. The bid and ask sometimes are far apart. It's harder to find opportunities. There's less liquidity, obviously, but I think you can find real yield and real opportunities, to your point, in those types of trades. So great point.
Yeah, and I think that's something that a lot of investors don't take into account very much, is that imperfection in the market. And so like you mentioned with a public stock, if you wanted to liquidate a public stock, you will liquidate it in seconds. And you will get that current market value. And if you want to buy something, you're going to buy it at current market value. You're not going to buy it at a discount to actual market value. The prices may decline at that moment and you might buy it that way, but you're not going to get it at a discount to its actual value. The beauty of real estate is it's an imperfect market. So there's opportunities to buy things at less than what they're currently worth. And I'll give you a really good example. Back in, I think it was 2011 or 2010 or 2011, the GFC was still kind of trying to work its way out. We had a broker brought us a multifamily deal. He wanted us to put an offer on, and my offer to him was half of the asking price, which was way less than what was owed on the loan, which was way less than what the previous owner had bought it for. And they were just like, there's just no way it's going to trade at that price. There's just no way. And like a month later, he calls me again, do you want to put in an offer? And I'm like, yeah, but my price is still the same, half of what you're asking. In a perfect market, it would have just sold, right? But it's imperfect market because there was no buyer at that price. And it took about 3 or 4 months before I finally got the call where the broker was like, all right, fine. You can have it because nobody else was taking it. In an imperfect market, you can find things at a discount because you have those kind of dislocations in the market and you don't have that perfection of, always having a buyer for a seller.
Well, Brian, hey, this has been an insightful conversation. Really appreciate you coming on today and sharing your insights. And hopefully we can all celebrate a successful 2026 a year from now when we have this conversation again.
I'm looking forward to that conversation.
So that wraps up this amazing conversation with Brian Burke. It was fun to talk about what happened in 2025 and his thoughts for 2026 and beyond.
If this one helped you refine your own playbook, follow the show and join the conversation at PassivePockets.com. There you'll find checklists, live reviews, community insights, and much, much more.
And on this note of 2026 planning, Paul, Jim, myself, we started a thread that turned a very active thread on the Passive Pockets forum about kind of what your strategy is, what your 2026 goals is. So go in there, read it, and we'd love to hear your thoughts and your goals as well.
Be sure to like and follow the show. And as always, happy investing.